Warren Buffett, Mastering Stock Market Investing Strategies for Beginners. Once upon a time, there was a young lad named Warren who got his start in the big world of investing when he was just 11 years old. Now, you might think that 11 is quite young to be dabbling in stocks. You'd be right, but Warren wasn't your average kid. You see, Warren was always curious about how things worked, especially money. So, when he bought his first stock at the tender age of 11, it wasn't just a random whim. He dove headfirst into the world of investing, trying out different strategies and techniques, even though he wasn't making any profits. But hey, he was having a blast. For years, Warren experimented with timing the market, studying stock charts, and devouring every book on investing he could find at the local library. He was fascinated by the whole thing, but he felt like something was missing. He was searching for a framework, a solid foundation to build his investing knowledge upon. Then, one fateful day in 1949, Warren stumbled upon a book called The Intelligent Investor by a guy named Ben Graham. Warren had never heard of Ben Graham before, but this book changed everything for him. In just 2 chapters, Graham laid out some fundamental principles that became the cornerstone of Warren's investing philosophy. First off, Graham taught Warren that a stock isn't just a random ticker symbol flashing on a screen. No, a stock represents a piece of real business with its own unique characteristics, competition, and management. Warren realized that to truly understand a stock, he needed to think of it as a business, not just a bunch of numbers on a chart. Then, Graham introduced Warren to the concept of Mr. Market. Mr. Market was a quirky fellow who showed up every day, offering to buy or sell stocks at various prices. Sometimes he was overly optimistic, and other times he was downright pessimistic. But here's the thing. Warren learned that he didn't have to listen to Mr. Market's every whim. Warren could capitalize on Mr. Market's mood swings by purchasing undervalued stocks, disregarding the noise in between. Lastly, Graham hammered home the importance of having a margin of safety. Just like you wouldn't drive a truck over a bridge that was barely holding up, Warren learned that he shouldn't invest in stocks unless there was a significant margin of safety. In other words, he needed to buy stocks when they were selling for less than their true value, giving him a buffer against potential losses. Armed with these 3 simple yet powerful principles, Warren set out to conquer the stock market. He focused on finding businesses with enduring competitive advantages, run by honest and capable management teams. And instead of trying to predict the market's every move, he patiently waited for opportunities to buy great businesses at bargain prices. So you might ask, what's the moral of Warren's story? Here are 5 key lessons that young or beginner investors can learn from Warren Buffett's story. Number 1. Start early and stay curious. Warren Buffett began his investing journey at a young age, showing that it's never too early to start learning about money and investing. Young investors should embrace their curiosity and start exploring the world of finance as soon as they can. If they don't have much money to invest initially, the knowledge they gain from early exploration can be invaluable later on. Warren Buffett's early start in investing highlights the power of compounding returns over time, making it crucial for young investors to begin their journey as soon as possible and maintain a curious mindset to continuously learn and grow. Number 2. Focus on long-term value. Instead of trying to make quick profits by timing the market or chasing hot stocks, Warren Buffett emphasizes the importance of focusing on long-term value. Beginner investors should learn to think like business owners, seeking out companies with strong fundamentals and enduring competitive advantages. By investing in businesses they believe in for the long haul, they can potentially reap the rewards of compounding growth over time. By prioritizing businesses with strong fundamentals and enduring competitive advantages, beginner investors can build a portfolio of investments that stand the test of time, generating wealth steadily over the years. Number 3. Ignore market noise. Warren Buffett's concept of Mr. Market teaches investors to tune out the stock market's daily fluctuations and focus on the underlying value of their investments. Beginner investors should steer clear of market hype or panic, keeping in mind that short-term emotions, not long-term fundamentals, often drive market volatility. They can avoid making impulsive decisions based on market noise if they stay disciplined and patient. Beginner investors should cultivate the discipline to ignore short-term market fluctuations and focus instead on the underlying value of their investments, understanding that the stock market's daily gyrations often have little bearing on the long-term success of quality companies. Number 4. Embrace the margin of safety. One of Warren Buffett's key principles is the importance of having a margin of safety when investing. Beginner investors should learn to assess the intrinsic value of a stock and only invest when the market price is significantly below that value. This margin of safety provides a buffer against potential losses and increases the likelihood of achieving favorable returns over time. Understanding the concept of margin of safety not only protects investors from downside risk, but also instills the confidence to stay patient and disciplined, knowing that they are investing with a buffer against unforeseen challenges. Number 5. Continuous learning and adaptation. Throughout his career, Warren Buffett has emphasized the importance of continuous learning and adaptation. Beginner investors should approach investing as a lifelong journey, committing to ongoing education and self-improvement. By staying informed, remaining open to new ideas, and learning from both successes and failures, they can continue to refine their investing strategies and achieve long-term success in the stock market. Just as Warren Buffett has evolved his investing approach over the years, beginner investors should commit to lifelong learning and adaptation, staying flexible and open-minded in the face of changing market conditions and new investment opportunities. Thank you for embarking on this enlightening journey through the principles of investing with us. We trust that Warren Buffett's timeless wisdom has provided you with valuable insights and actionable strategies to navigate the complex waters of the stock market. Remember, successful investing is not just about picking the right stocks. It's about cultivating a disciplined mindset, focusing on long-term value, and embracing the power of compounding returns. If you enjoyed today's episode, be sure to like, share, and subscribe to Money Ocean for more insightful content on finance, entrepreneurship, and personal development. Join our community of like-minded individuals committed to achieving financial freedom and unlocking their full potential. Until next time, may your investments be prosperous, your dreams be bold, and your journey towards financial success be filled with abundance and fulfillment. Happy investing, and may the tides of fortune forever be in your favor.